the momentum as we make the turn. Is there enough of it to keep the bulls charging ahead? Let's ask Avery Sheffield, the co-founder, CIO, and senior portfolio manager of VantageRock, right here with me at Post 9. Welcome back. It's good to see you.
Great to be here.
So how do you answer that question? Is there enough momentum in what's been, for many, surprising first half as we make this turn?
Yes, I'm not sure. So from a fundamental standpoint, I think the economy, what we see is we are seeing inflation kind of slowing, moderating, even rolling over, even going negative in some categories, which is potentially good as a tailwind for consumers.
Great.
Yes, it's great.
Right?
It's great. It's not necessarily good for companies that are experiencing the pressures of that inflation, right? But that is like one dynamic that's a net positive. As long as the market continues to go up, that's a net positive. And then you, on the other hand, and jobs are still pretty strong.
Yeah.
On the other hand, you have rising credit card debt, rising interest costs, right, creating some pressure. And so I think it's still like a tough call of what is going to happen moving forward. And so from a stock perspective, what we're focused on is where is there just too much negativity priced in on the long side, and where are expectations very optimistic with high valuations in companies that maybe are going to have more issues, because I think it's a really tough call. It feels to me like to be a little weak, but if the market keeps going, that'll be a nice tailwind. And then also, you're going to have the student loan debt come due
in September, right?
Which is kind of feels like forever from now, but that's actually quite meaningful, $100 billion, 2% of retail sales.
If somebody said, I mean, do you think the risk reward is better now than it was? Would you say
it's
yes?
Worse.
It's worse?
I'd say it's worse for the market as a whole,
because we've rallied a lot?
Yes. I mean, just valuations are too high. I mean, I kind of concur with Mike Wilson here in that it's like it matters what you pay, right? I mean, and he's calling for a bearish call, kind of more economic. He's been bearish, but he's continuing to be bearish, right? And he's continuing to be bearish, especially at the levels that we're at. But he's saying, well, maybe we'll have the market could be strong next year from a very different level. So these levels look high. Can they keep running? Yes. Could this be 2006, 2007? You see issues down, but they're far enough down the road that we just forget it. We certainly could, but I feel like it's just safer to buy names that have more negativity priced in.
So the run that we've seen in tech,
yes.
What do you make of it? Does it make sense to you? Do you think it has legs to go further?
Right. So I think, look, the AI is clearly driving demand for NVIDIA's chips and some related other components. Certainly Microsoft's in a great place related to that. But outside of the build out, everyone's trying to figure out what's the business model going to be. So there is going to be a decent amount of investment spending there, but which companies benefit, how many benefit versus how many are disintermediated by new, cheaper startups putting together really easy to use AI applications. I think it's really unclear. So I think I think it's risky to be buying names that have a lot of AI hype in them that don't have a business model behind them. Outside of that, what we've seen is tech spending is actually very much related to net income, and that determines your CapEx budget for the next year. Net incomes of companies are okay, but somewhat under pressure because of the inflationary dynamics we've seen. Mm-hmm. And so what that means is that can crowd out other technology spending. So I think you really have to be careful in where you pick your spots.
That's funny. I mean, when you say all that, and I look at the sheet, and you like Intel.
Right,
you like Intel. Come on.
I mean, aren't they being displaced by NVIDIA? Yes, exactly.
I justify it, though. I want to hear your explanation.
Right. So, so we always like to find, we always are interested in where people just overly negative and things won't be as bad as people anticipate. And there are company-specific idiosyncratic factors that can turn things around. So for Intel in particular, right, one of the largest semiconductor manufacturing companies in the world, it's really lagged a TSMC on the foundry, on the manufacturing side, and AMD, NVIDIA, and others on the design side. I mean, basically, really not doing well on either side. But what we have here is really, I think, the beginning stages of a turnaround underway. Patrick Gelsinger, who had been at the company for over 30 years, left for EMC and VMware for 11 years, very well run. Michael Dell, being involved in those companies, knows how to run a really good business. Came back, just in the past couple years to really create just much more discipline and efficiency. This is an execution-driven business. He's separating the P&Ls between foundry and logic and creating more accountability. Analysts are very skeptical about whether this can be successful, but you are starting to see some early signs of success in designs getting better. He's identified $10 billion of costs he's going to take out the next 2 years, $3 billion this year. They're investing $60 billion with help of governments in new semiconductor manufacturing facilities here in the U.S. and Germany, in Europe. And so there's a lot that could go right. An evaluation on normalized earnings that's half of TSMC, a third of AMD. So if they execute, there's a lot of upside.